We have just got some new documents from the Federal Reserve, a new survey, new insights that confirm a financial crisis worse than 2008 is here and it's only the beginning. But of course, like always, these central banks always try to spin it to tell you that don't worry, there's no reason to panic. The system is fine. The system is sound. In this report, we're going to find out what the biggest risks for the economy, for the banks, and for the financial system are, and what the Federal Reserve is so worried about. So you need to pay attention and start preparing right now because time is quickly running out. So everyone, let's not waste any time. Let's get straight into the news, the facts, and the data. Listen to this. Fed flags concerns over credit tightening and financial stress. This is what I've been warning about, everyone. I've been saying we're in the middle of a credit crunch and a credit freeze right now. I've even been having people email me to tell me that they're loan officers, they're working at the banks, and a lot of their loans have fallen by 50%. They're telling me it's much harder to get approved. I'm having people tell me that their overdraft for their bank accounts are being closed, their line of credits are being closed, and their credit card limits are being slashed. Now you may think, well, that's a great thing. People aren't getting in as much debt. They'll be more financially free. Well, yes, that's good for the individual. It's very, very bad for the economy because a lot of people use debt to spend, and one person's spending is another person's income. And what this is going to lead to is a huge slowdown in economic growth, in spending, and we're going to see more layoffs, and these crises get even worse. But not only this, there's a lot of assets on the bank's books, and the banks are coming under severe financial stress, so let's find out exactly what's happening. A Federal Reserve report warned that banks' concerns about slower growth could lead them to make fewer loans, accelerating an economic downturn, and highlighted commercial real estate as an area of heightened risk that would draw more scrutiny from bank examiners. Okay, that's a big statement, everyone, so let's unpack this. So first, like we talked about, they're making fewer loans. This is going to accelerate the economic downturn. And the biggest risk, like I've been warning people about for months now, and this is what always happens, I'll try to warn people months ahead of something happening so you can have time to prepare. But unfortunately on YouTube, when you say something, people want it to happen the next day. Otherwise they say, you're wrong, there's no crash happening, blah, 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 just doom and gloom clickbait. Well, no people, these things take time to play out. And again, I need to warn you in advance so you have time to prepare. It's no point in me waiting for the day before it happens to tell you, look, you better prepare for a financial crisis because there's not much you can do in a day. So what this means is there's going to be much more scrutiny from the banks and their willingness to lend to the commercial real estate sector, and that's going to cause the commercial real estate crash to get even worse. The US Central Bank's Financial Stability Report released Monday is the first since the 4 regional lenders collapsed. The episodes prompted weeks of wild trading in bank stocks and forced regulators to take a series of extraordinary steps that included backstopping all deposits at Silicon Valley Bank and Signature Bank. So that's why this report is so important, everyone, because we've been waiting for the Federal Reserve to release their thoughts, their report, ever since these 4 banks went under. Concerns about the economic outlook, credit quality, and funding liquidity could lead banks and other financial institutions to further contract the supply of credit to the economy. A sharp contraction in the availability of credit would drive up the cost of funding for businesses and households, potentially resulting in a slowdown in economic activity. Well, again, they tried to use very friendly language here. They don't want to alarm anyone because if they admit what's really going to happen, it'll become a self-fulfilling prophecy and the economic downturn would be greater than if they try to paint a rosy picture. So a few more insights here. There is a huge liquidity crisis for the banks right now. They've lost a lot of money on these bonds, on these commercial mortgage-backed securities, these other residential mortgage-backed securities. Customers are pulling out their money like crazy. And they did something crazy with Silicon Valley Bank by backing all depositors, mostly because there was a lot of billionaires that had money there and a lot of politicians. So it's very interesting that they guaranteed all those deposits, but not other banks. But there's a huge problem in the banking system that the Federal Reserve cannot fix, and that is the banks aren't paying depositors enough money. You may be lucky to get 1 or 2% interest. So big money, they're taking their money out of the bank account and they're putting it in a money market fund where they're getting 4 or 5% return in short-term treasuries. Another thing they're very, very worried about is this is going to drive up the cost for credit. The banks are going to be very selective to who they give loans to. They're also going to increase these interest rates. That's going to be more and more of a burden for businesses and for consumers. And again, this is just simple math. It's going to be less economic growth and more layoffs, and we will have a worse recession, I think, than the Great Recession of 2008. Overall, domestic banks have ample liquidity and limited reliance on short-term wholesale funding, the report said. Structural vulnerabilities remained in short-term funding markets. Prime and tax-exempt money market funds, as well as other cash investment vehicles and stablecoins, remain vulnerable to runs. Life insurers face elevated liquidity risk as they increase holdings of risky and illiquid assets. Okay, so also some very more interesting insights here as well. They're saying don't worry, and it's quite funny because they're kind of speaking out of both sides of their mouth here. They're saying, look, there's liquidity stress for the banks, but then they're saying overall there's not a liquidity issue. And they're saying the risk is the short-term lending, a lot of tax-exempt money market funds, and very interesting, a lot of life insurance companies face a big risk, especially with an aging population. They said they have a lot of very illiquid assets. But what is the biggest worry for them right now? The report said the shift to telework could reduce demand for office space and lead to a downturn in the value of city retail properties. The magnitude of a correction in property values could be sizable and therefore could lead to credit losses by holders of commercial real estate debt. So again, the biggest risk for the banks besides a bank run is the commercial real estate sector. And it's not just these office buildings, but also the retail spaces, the restaurants, the cafes around these office spaces where workers normally go. Well, they're also going to be facing big issues as well because they're not going to have as much foot traffic. So let's listen to the Fed's response here. The Fed said that in response to concerns around commercial property debt, it has stepped up monitoring of CRE loan performance and expanded examination of procedures for banks with significant CRE concentration risk. So the Federal Reserve is very worried, and they're paying very close attention to this situation that's rapidly getting worse, so we all need to do the same. And a shocking admission that came out of this report, the Federal Reserve themselves said they failed, and they failed big. The Fed said in a lengthy review of the collapse that the bank failed its own liquidity stress tests, while its examiners didn't recognize the risk of critical deficiencies in the firm's governance, liquidity, and interest rate risk management. Well, everyone, doesn't it just happen time and time again? The Federal Reserve creates a boom, they create a bubble, asset prices get too out of control, then they come in and crash the markets and cause a financial crisis. They do the same thing again and again and again. They cause so much financial stress, so much economic pain, and they just go, oopsies, my bad. I think they need to be held more accountable, just like anybody else in any other position. At the minimum, they should lose their jobs. But no, Jerome Powell, he just got another term as a Federal Reserve chair. And this is why I always tell you, don't listen to the central banks, because like this banking crisis that I've been warning about for a year now that would happen, has happened, but the Federal Reserve will never ever tell you. They want to keep you in the dark, and then they'll try to say, oh, look, you know what, we really didn't see this coming, when really people, they did, but they're trying to keep you in the dark. But I'm sure what you're wanting to know is there any other areas of risks that we should be concerned about? Well, yes. There's risk everywhere. It noted that credit quality in the economy remained strong. I debate that, though delinquency rates in some segments, such as autos and credit cards, have increased. That's what I did a video on yesterday, everybody, how credit card delinquencies are rising, and also the auto sector. There's a huge crisis going on in the auto sector. A lot of these loans have gone bad. Yes, while the used car market or these loans normally are underwater, some of them are underwater by 50%. Because people severely overpaid. They also warn 4 other risks that they're monitoring is asset valuations. Assets are still severely overvalued, and there's a big risk that they could drop and drop massively, which I think will happen once a real recession kicks in. Borrowing by business and households. Debt is also at record levels right when interest rates are rising. So a lot of these loans are going to go bad on the bank's books, and people aren't going to be able to take on more and more debt to sustain their lifestyle in it. Another risk, leverage in the financial sector. What a lot of people don't realize, it's not just loans these banks are doing. They're doing a lot of very high risky derivatives. So if they go under, that could cause the banks to collapse as well. And funding risk. The Fed said that in 2020 and 2021, banks added nearly $2.3 trillion in securities to their balance sheets, primary fixed rate US Treasury securities, and agency guaranteed mortgage-backed securities, most of which were placed in their available for sale and held to maturity security portfolios. But as rising interest rates began to result in lower bond prices, banks had declines in fair value of $277 billion. That is a huge loss, everyone, $250 billion in AFS portfolios, and 341 billion in hold to maturity portfolios. So this is absolutely massive, everyone. Banks are sitting on $600 billion in losses on these bonds and these mortgage-backed securities. Now, in some circumstances, this would be okay for the banks, but what we're seeing right now is a bank run. So what happens when people pull their money out of the bank because they're worried it's going to fail or they want to put in a money market fund? These banks are forced to sell these assets at a loss, and that's why we're seeing huge amounts of banks failing. And again, people, this is only the beginning. It's going to get worse. And I have a chart to prove it. So this is a chart of deposits at all commercial banks. We can see here it hit a peak in July 2022 of 18 trillion. But every single week it has fallen and fallen lower, and it's now continuing to fall in April. This is the latest update we got, April 26th. It has fallen down to 17.1 trillion. So again, from the high of 18.1 trillion, we've seen $1 trillion in deposits taken out, and this trend is accelerating. And unlike the last financial crises, the government won't be there to save the day because the US government is in a very sticky situation right now. Look at this. Yellen warns of economic chaos unless Congress raises the debt ceiling. How many times have we seen this circus, everyone, where they keep on saying, look, we got to take on more and more debt, otherwise the whole system is going to implode. Which is, yes, that's true, but the reason why we're in this situation in the first place is because the government keeps on taking more and more debt. So even though I do expect them to raise the debt limit this time, eventually there will come a time, people, where the US government defaults. And it has sort of already defaulted before. In 1933, when the US government confiscated everybody's gold, that was a soft default because the US government didn't have the gold. Then also in 1971, when they came off the gold standard, that was a soft default because, again, they couldn't keep on printing money. They couldn't pay their debts by having 10% or whatever gold reserve requirement there was. So everyone, what this means is the economy and the financial system is being attacked at all angles. So everyone, what this simply means is the economy, the banking sector, the financial system is being attacked from all angles. We didn't fix anything in 2008. They just kicked the can down the road. They try to print their way out of it. But eventually the road is going to end and we're going to have to face the music, let this market reset and rebuild from a more sustainable base. But everyone, what do you think about all of this? Let me know down below. Now, for my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.